Welcome back to the 401k DC Hub, where we continue to simplify retirement plan operations for BPO associates, back office professionals, plan admins, and anyone stepping into the world of 401k support. Last episode, we met Ava, the plan administrator who discovered the critical role of compliance in maintaining a qualified plan. Today, we're going to follow her journey as she dives deeper into the numbers, thresholds, and tools that keep the plan clean and compliant. Understanding contribution limits, the foundation of compliance first. Ava needed to master the contribution limits set each year by the IRS. These limits apply to both employee deferrals and overall contributions. As of the latest IRS update, elective deferral limit 402G for 2025. Employees can defer up to $23,000 of their salary into a 401 catch-up contribution, age 50 plus. Participants aged 50 or older can contribute an additional $7,500, bringing their total to $30,500. Annual addition limit, 415C. This includes employee plus employer contributions. The total cannot exceed $69,000 or $76,500 with catch-up contributions. These limits are indexed yearly for inflation, so staying updated is key. Ava set calendar reminders to cross-check limits every January on ars.gov. The highly compensated employees, HCEs, factor. Here's where compliance gets a bit technical. Ava learned how important it is to identify highly compensated employees, or HCEs, for testing purposes. For 2025, an employee is considered highly compensated if they earned $155,000 or more in 2024, Oregon. They own more than 5% of the company, regardless of income. This matters because of the ADP and ACP tests, which compare contribution percentages between HCEs and non-HCEs. If the plan favors HCEs too heavily, it fails the test, and corrective action is required. What happens if a plan fails a compliance test? Let's say Ava's plan fails the ADP test. What happens? She has a few options. 1. Refund the excess contributions. The most common fix, refund the excess deferrals made by HCEs with earnings. This must be done by March 15th of the following plan year to avoid a 10% penalty. 2. Make qualified non-elective contributions, unikids, instead of taking money back from HCEs. The plan can add money to NHCEs to bring the averages in line. This can be more expensive but preserves HCE contributions. 3. Recharacterize contributions. In some plans, excess contributions can be shifted from employee deferrals to after-tax contributions. Although this is less common and must follow strict rules. Digging deeper into Form 5500 and audit triggers, Ava also learned that Form 5500 isn't just paperwork. It's a signal to the IRS and deal. One small mismatch or red flag can trigger an audit. Here's what she double checks before filing. Total participant count over 100 requires an independent audit. Contributions matching payroll records, accurate reporting of fees, distributions, and assets inclusion of all required schedules, especially Schedule H for large plans or Schedule I for small plans. She also prepares a plan audit package for external CPAs if the plan crosses the 100 participant threshold. Common operational errors and fixes. Even well-run plans hit snags. Ava made a checklist of top operational errors to watch for and how to fix them. Late deferral deposits. If salary deferrals aren't deposited timely, generally within 7 business days, it's considered a prohibited transaction. Deposit missed contributions plus interest file form 5,330 and pay and excise tax incorrect match calculations. Mismatch between payroll and employer match. Ava recalculates and makes corrective contributions to affected participants. Eligibility errors. Missed enrollments must be corrected with retroactive contributions and notice to participants, often using the Employee Plans Compliance Resolution System. EPCRS. Special testing considerations. Some plans are safe harbor plans, which automatically satisfy ADP ACP testing requirements in exchange for making mandatory employer contributions and providing annual notices to participants. There are 3 common safe harbor options. Basic match, 100% on first 3%, then 50% on next 2%, next 2% enhanced match. Usually 100% on first 4% or 5% non-elective, 3% to all eligible employees. Regardless of participation, AVA found that safe harbor plans can reduce admin headaches, but come with their own rules, especially around timing, notice delivery, and amendments. Compliance is a year-round practice. Ava thought testing was a once-a-year event. Now, she knows better. Compliance is an ongoing discipline. From eligibility tracking, contribution monitoring, and vesting reviews to documentation and audit prep. She created a compliance calendar, noting key milestones. January, confirm new IRS limits March 15th. Correct failed ADPA ACP tests July 31st. File Form 5500 or October 15th with extension December 1st. Deliver safe harbor. Notice is ongoing. Review payroll, eligibility, and loan policies. Conclusion. Compliance. Continued compliance isn't just checking a box. It's building a trustworthy foundation for retirement readiness. Ava now understands the details, limits, deadlines, and correction paths that keep the plan qualified and protected. If you're a back office associate, admin, or BPO team member, this knowledge empowers you to be more than a processor. You become a plan steward. And remember, this podcast is for educational purposes only. Always refer to IRS and Dell websites for the latest rules, thresholds, and procedures.